All right, in this video, I'm going to be teaching you how to use the fair value gap now. There are a couple uses for the fair value gap. The fair value gap can be used as reversal points, as entry points, and it can also be used as like PT areas or just simply as a draw on liquidity. So there are a couple ways you can use it, and I'm going to be showing you both examples at play here. So look at my cursor, look where it's moving. 1, 2, 3. That is a bearish fair value gap. We can all see that, right? See how we got that bearish fair value gap right there? I want to plot that on the chart. Now, it's officially delivered that area of price now, but I want you to forget that this price action on the right has happened. And I want you to imagine with me for a second that it's just trading lower, that it's just trading lower, trading lower. So we have an imbalance right here, and we know that whenever price leaves an imbalance like that, it means it's an inefficiency. It's an inefficient area of price. Price does not like to leave areas like that imbalanced. It's going to want to rebalance that price action because it's an inefficiency. Okay, it wants to efficiently deliver that price action. So where there is inefficiencies, there's opportunity to make money. There's opportunity to capitalize. And that is one way that you can do it. Not only can you use the fair value gap as a reversal point, as an entry point, but you can also use it as a PT, as a draw, because we know price is going to want to return to that particular area to rebalance that price action. So that's where it becomes useful when utilizing lower time frame market structure and looking for that lower time frame trend up into that imbalance, up into that draw of liquidity. That's where it's useful. So we're going to show you both examples at play here. That's that draw, but we're also going to show you the entry point, because that is another way you can use it. Because you got to think, as we've gone over in the market structure series, your high probability market structure shifts, they'll leave a fair value gap. They will leave a fair value gap on the shift. So right here, for example, see this? There is a 15-minute fair value gap. See that? 1, 2, 3. We have a bullish fair value gap right there. So on that shift in market structure right there, on that surge up higher, this area of price action was not efficiently delivered. Okay, it was too extreme. It was too strong of a shift. It did not have a chance to efficiently deliver that price action. What does it what does it want to do? It wants to efficiently deliver it. And once it rebalances that price action, once it collects the necessary orders, what do you think it's going to want to do? What's the most likely scenario that it's going to want to do? It's going to want to resume higher because it has completed its objective. It's collected the orders. It's rebalanced that price action. It gave smart money an opportunity to get on board for higher prices. So it rebalances that price action. It's now efficiently delivered, 100% efficiently delivered, and it continues its trend higher. Then it pulls back, finds support, and then it continues higher into where? Where did it continue higher? Into that upper 4-hour imbalance. Let's zoom out just to remind you that to see that bearish imbalance that we marked to begin the video. We are now drawing up into that bearish imbalance right there. Why did it do that? Because it was an imbalance. As I've just told you guys, price does not like to leave areas on the chart like that imbalanced. It wants to rebalance it. And then that's where it's necessary to have a strong understanding of market structure, because then we can utilize lower time frame market structure to take price up into that upper imbalance. And whenever you're playing the draw, whenever you're using fair value gaps as a draw on liquidity, when you're using them as a PT, this is how you're going to do it. This is essential. You're going to be utilizing that lower time frame market structure to take it up into that draw. It's as simple as that. For entry points, again, the most common place that I use the fair value gap for entry points is on the shift in market structure. Okay, that's what I look for. I look for that shift in market structure. I look for that change in delivery. I look for that change in trend. And then once price retraces down into a discount inside that fair value gap. So remember, discount's important as well. Let's take our Fibonacci from the low prior to the shift to the high. See how it pulled back below 50% equilibrium inside that fair value gap. That's what you want. Once it does that, it's efficiently delivered the price action. That is a good entry point. So I've given you like both scenarios at play here. We use the fair value gap. The best place to use the fair value gap for entry is on the shift in market structure during a key time, like a New York killstone is what I like, or you can also use the London killstone. London kill zone is 2 to 5 a.m. Eastern time, and New York kill zone is 7 to 10 a.m. Eastern time, but I push it to 11 because I still get a lot of opportunities in that period. But that's where you want to keep a close eye on for these fair value gap entry points. Again, where do you want to keep a close eye on for fair value gap entry points? Well, when trading Forex, 2 to 5 a.m. Eastern time, 7 to 11 a.m. Eastern time. Okay, futures, a little bit different. Same deal, you'll get some nice moves during the London session, even with futures, like 2 to 5 in that period. But with futures, if there's news out, if there's high impact news out, keep an eye on 8:30 to 11 a.m. Eastern time. If there's no news on that particular day, then 9:30 to 11. And also with futures, you have power hour. So, 2 to 4 p.m. Eastern time. That's when you want to keep an eye out for these fair value gap shifts, for these entry points. That's very, very important. And again, you use the draw. You can use upper imbalances as a draw on liquidity as a PT area. And then you utilize your lower time frame market structure. You utilize that lower time frame change in trend to capitalize on that move up into the upper imbalance. Because price wants to rebalance that price action, guys. It wants to rebalance it. Price does not like to leave areas inefficient. It's going to want to rebalance it. And your job next is to just figure out when that change in trend occurs and then just hop on board and enjoy the ride up into the imbalance. That's how you do it. Both scenarios at play.